Hey, and welcome to this video. In this video, I'll be showing us how to use the Bollinger Band trading strategy or the Bollinger Band indicator, whichever one you want to call it. So, Bollinger Band. We don't need to go about who came about with what name or who did this, who did that. I would explain everything on the group. The main idea behind the video is to tell us how to use the Bollinger Band and what to use it for, when to use it, what are the advantage and disadvantage, what kind of market can I use the Bollinger Band for. So let's get started with Bollinger Band. Now, Bollinger Band measures volatility of price over a period of time, or over periods of time, or time period, whichever one you want to. All you need to know is that Bollinger Band measures volatility. Now, we have indicators that measure momentum, like the ones we've talked about. This one measures volatility. Lets us know what the market price is doing, what is going on with demand and supply. Is demand high at this time, or is demand low? When the demand is low, that means the supply is high. But could it mean that there is really no demand and supply in the market? Could it be that market is really not doing anything? For example, if we look at this place, we would see that there was a sharp increase in volatility from here to about this point. There were volatility, but if we look at this point, okay, there was volatility up until this place. Okay, up until here. But if we look at this point, you would see that you really didn't know who was in charge of the market. Was it the seller? Was it the buyer? Who was in charge of the market? You really didn't know. So at this point, we can say that the volatility was quite much, and at this point, we can say there is really no volatility, and the market resumed, and so it has been like that, over the past few hours. So Bollinger Band lets us know who is in charge of the market. It is mainly used for trading a trendy market. Okay, Bollinger Band strategy is used for trading the trendy market, but that does not mean you can use it for the ranging market. Now, the mistake that most people make is that they think that you should either buy or sell where price has gotten to the end of the band. Now, so I don't sound like let me just bring out the Bollinger Band so that we can see what I'm talking about. So you come to the indicator as usual, and then you type your Bollinger Band, and then you add it. So you would see something like this. So this is how the Bollinger Band looks like. We have the upper band, we have the lower band, and we have the middle line. But what it does is that, like a band, like an elastic band, it keeps price within a confined zone, or within a range, so to speak. But that does not mean that price cannot break through the band. But fundamentally, even when price breaks through the band, price will still come back and make its way inside the band. Okay, so that's the first thing you should know about the Bollinger Band. It controls price. It regulates how price moves. Price moves within the band, but it can move outside the band. So there are structures. You have the Bollinger Band bounce. When price gets to the this band, it bounces. Let's go to a higher time frame so we don't have to keep. All right, so we have something like this, that when price got to this band here, okay, let's start here, it bounced, and then it got here, there was another bounce, and then there was another bounce, there was a bounce, there was a bounce, and there was a bounce, and the bounce is going to continue to the future. So that's what the upper and the lower band does. Now, if you are wondering for the middle band is actually a 20 period moving average. Now, you know what a moving average does. Moving average shows us the direction of the trend. It acts as support and resistance. So we can say this middle band here, it acts as support and resistance to a point. For example, if we look at it from this place, you would see that price was not able to break through this middle band. Was not able to break through this middle band. Then when it broke through, it acted as support and resistance. Now, where most people get it wrong is to think that when price gets to this lower band, automatically uh, the band will send price up, and it would make it back to the upper band. And when it gets to the upper band, the price will send it back down. Okay, in a way, that can be right, but it's a short-sighted view of the Bollinger Band and what it represents. For example, if you notice that at this point, price got to this lower band, and instead of it sending it back up, price kept on hugging this band, and it continued like that for a long time. Okay, so that is the first of many to prove it wrong, or to prove that assumption wrong, that once price gets to the lower band, it's automatically going to send it to the upper band, and the upper band would be so nice to send price down to. So if you check this place too, the same thing happened. Price did not return from the upper band, it kept on going, and then all of a sudden. So this is the fundamental knowledge behind this strategy. Bollinger Band lets us know when the market is in a period of high volatility and when there is low volatility in the market by doing something called the Bollinger Band squeeze. If you've seen uh, a cobra before, you would see something like the cobra flexing its, is it jaw now? What do they call it? I don't know what they call it. But if you've ever seen someone choke, or you've seen a movie where they choke someone, you realize that you would see something like your hand wrapped around the person's neck, and then there will be a compression. So when you see a compression on the Bollinger Band, it shows that the market is in a period of low volatility, and at that period, there's really little demand and supply. Okay, so before I move on, let's try and go back in time to see those periods of chokes in the market. So here we have sort of a choke here. Okay, so the market was it was expanded at this point, and then all of a sudden we saw that choke around this place. Okay, and then there was an expansion, and then moving on, you would see something like that choke again, and then there would be a little bit of expansion, and then you see a choke. There was a small expansion here, and then a small of a choke here rather, an expansion, a choke or compression. Okay, there was small compression here, and then like that. Let's go to another time frame so we can all right, so if you look at this, you would see this choke here, or this compression here, and then you would see a release, and market will go in one direction. You see a compression here, you would see a release, and market will go in another direction. Okay, you would see a compression here, and market went in one direction. So we would see compressions over time, and market moving in one direction immediately after the compression, or when the compression is over. The reason for this is that after every compression, the market is bound to make a big move. Okay, so since it measures volatility, those periods of compression means that there was little demand and supply in the market. Not that there wasn't any demand and supply, but the market was silent at that particular period. So after a period of low volatility, what usually follows is a period of a surge in demand, so to speak. So there's usually a surge in demand after a period of low volatility. Let me demonstrate. Let me demonstrate it for us so we can see. So at this period, okay, at this period here, there was little demand. All right. So let me zoom in so that we can see. Now, the more I zoom in, the more the compression does not look like a compression, but it's actually a compression. So over this period from here to this point, okay, the band was under distress. We didn't really know what price was going to do. The distance between the upper band and the lower band looked like it was not so much. Okay, so at this point, you don't know who is in charge of the market. Do you buy or do you sell? This was uh, a form of a choppy market, although it was still sending price from the upper band to the lower band, but there was a tight squeeze. Now, after this tight squeeze, you would realize that we have something like this. Okay, so we started seeing bigger candles, bigger candles, bigger candles, and the lower band started going in another direction while price was hugging and even breaking through the upper bound. So it basically let us know that okay, the period of low volatility is over, and the market is about to start making big moves, and then we start to see moves like this. Although there was a correction in a not too distant future, but if we really want to see how it looks like very well, let's go to a daily candle so that we can see it very well. Since the daily candle measures change over a quite a number of times. So there was this compression here, and this is telling us that there is a period of low volatility. We are having a Bollinger Band squeeze. It's like someone is putting their hands and trying to squeeze over the band to just squeeze life out of the band, and then all of a sudden we start seeing a release. Okay, one band is going up and the other is going in the opposite direction, and the candles are hugging one band. So it's letting us know that the market is in a period of high volatility now. There is demand in the market, and the buyers are obviously in control because the price is hugging the upper band. So basically, what it does is to let us know that there is a period of high volatility in the market that is telling us that they are either buying or they are selling. Okay, so that is what the Bollinger Band does. When there is a squeeze and then there is a release of the squeeze, is letting us know that market is either going in one direction or is going in the opposite direction. Now, for people who have told you that you buy and sell when price has touched the upper band because it would send it down, it might be right to an extent, but you cannot do it blindly because you don't know when the market is going to break through into a trend. Okay, if you want to trade a range, that is advisable for something like this. For example, this is something like this. We can say you buy at the upper, you sell at the upper, you buy at the lower. The reason why you can do this is because this market is not looking so compressed. So we can still say there is still volatility in this market. Okay, we can still say there is a bit of volatility in this market. So if you want to, you can do that, but you can't do that every time because you can't always outsmart the market. That is like trying to beat the market at its own game. All right, so let's assume that you've been doing that at this point. For example, let's assume you just bought here, you sold here, you bought here, you sold here, you bought here, for example, thinking that price will keep going up. All of a sudden, the market, okay, still went in your favor at this point. It went in your favor, and all of a sudden, you were thinking market would go back up and would reach this place, but it decided to shock you and it kept on going down. You would not know. That is why I said you should not just accept that ideology so blindly. Now this is even quite simple. What of something like this? So we are having, there is a constant tussle between whether price is going up or it's going down. But as you can see, the gap is getting tighter, as if there is a bit of a squeeze, and all of a sudden this one started going up and price started hugging this place. So this is why you can't always assume that it would keep bouncing forever. Bollinger Band does not always bounce. There are times that the compression will be released and there will be so much volatility in the market that it will push price in one direction, and trust me, it can push price to one direction for a month. Okay, I might be wondering, what if I miss my entry point? What if I am not able to enter the price? This is the essence of our 20 period moving average. The price would always make a few pullbacks and some correction back to the 20 period moving average, and the 20 period moving average will be so generous to push price back to the normal direction where it is going. For example, if we go back in time and we see this price started going up here, and this lower band started going back down. So it was this 20 period moving average that was serving as our resistance, our support rather, that was pushing price back up. So it got here, it tested it, and it pushed it back up, and the trend was short-lived. But if we should look for bigger trends and more significant trends that happened, would actually, okay, let's look at the weekly time frame, for example. All right, so this is a very strong move down. Okay, so we can say the Bollinger Band was quite wide here from this point, and then all of a sudden when you got here, the compression was quite much. Okay, and then it started parting way. So when it crossed to this line, you would, the normal knowledge will tell you that this was supposed to send it back up. Okay, but as you can see, market has started turning to this place. 20 moving average has turned to this place, and the upper band and started going in the opposite direction. So price started trending down at this point. Now you might be wondering, okay, I was able to enter it here. Where do I enter? Remember, you don't just enter the market anywhere. Price went to test our 20 period moving average. Okay, that's a good place to enter if you want to enter, and then start coming back down. And as usual, no market trends forever. There was another correction on this point. So that's just telling us that the Bollinger Band is best for riding the trend, but that does not mean that you can't still make small profit even inside the band. So the fundamental principle is this: when there is a compression, there is low volatility. When there is a release, then there is something. Market is doing something basically. So you should want to look to buy or to sell. But as usual, I don't recommend you use this principle alone without any other guiding principle. So if you look at this place, there was a tight squeeze. All right, so you can zoom out to see the full picture. There was a tight squeeze uh, at this point that was tighter than what we've been seeing. Although the market is in an uptrend, but there was a tight squeeze here to show periods of low volatility, and then it was released. So market kept on trending up, and our 20 period moving average was serving as our resistance, our support, and it kept pushing price down. And here too, there was a tight squeeze, and then it sent price down too. So your Bollinger Band is designed to show you periods of high volatility and low volatility in the market. You can use it regardless of the time frame that you are trading. Okay, say we want to choose the uh, let's see the five minutes for example, so that you don't say it's you can only use Bollinger Band if you are a probably swing trader. No, you can use it regardless of the type of trader that you are. So market is quite compressed. Let's try to bring this up. Okay, so slow and steady does it. All right, so this is the 5 minutes time frame, and as you can see, it is still applicable in your 5 minutes time frame too. So if you come back to this place or come down here, you would see a tight squeeze at this point. Now you would understand that this is a period of low volatility, that nothing is really coming out of the market. If you are trading Bollinger Band and you want to either buy or sell at this point, then you won't blame anybody for your mistakes. But notice what happened here. This band started trending in the opposite direction, and the gap was getting wider, and the next candle was a very strong one, and a strong one followed. A strong one followed. Now, the lower band started returning back to the other side. That was showing that okay, that was the end of that strong momentum that was out in the market. So that is what the Bollinger Band teaches us normally. That when there is a squeeze, there is a period of low volatility, and most squeeze they are usually followed by a larger outbreak of the market, whether the market is breaking up or the market is breaking down. But you can still make buy and sell decisions inside the band, provided that you use other confirmations, probably your support and resistance, for example. Okay, so if you add your resistance at this point, say you do it at this point, you will understand that okay, price is likely going to respect it at a future date. All right, so if you come towards the future, this is the upper band. So this is the upper band now. This is still, it's coinciding with your resistance. So if you want to sell at this point, you are not selling just because the price has reached your upper band. You are selling because your resistance is not too far away. Okay, if you decide to lower it down up until this point, you can lower your resistance down to this point, so it will coincide with this previous candle. You will realize that okay, this is matching too. It is something of a confirmation, but you are not doing it because your price has just gotten to the upper band. No, the Bollinger Band is not just because price has gotten to the upper bound and you should buy or sell. Basically, the fundamental principle is that it is showing us market volatility. So another example of whether you can, if you check these preceding candles, you will see If you drop it here, you would see that this is actually a very strong support. Okay, going back into the future, this is the lowest point of the band. It is normally supposed to send price up, but you won't just make buy or sell decision based on this alone. You would want to, okay, this is a support, so I can trade this. So you want to enter the market. So you have two confirmations now. You are trading because there is a significant support at that point, and you are trading because it is the low of a band, not just because it is the low of a band. Because if you rely just on that one, you realize that it can always take out your low, and you would not have something significant to take out of the market. So there was a squeeze here, and there was a surge up like that. So that is the basics of Bollinger Band, understanding Bollinger Band. You can try out with different time frames that you want. You can try the 1 month if you don't mind trading the 1 month, or if that is the time frame that you trade, you can try the 1 month. Okay. So once there is a squeeze, most squeeze are usually followed by uh, periods of breakout. You would understand that one person is in charge of the market. So that will help you to catch trends if you are someone that appreciates trading to trend. Once you see that, okay, the other candle is probably moving, or the other band rather is moving in an opposite direction. You can see for this one, it was going up, this was going up, and then there was a sort of a pause. Uh, this one started going in the opposite direction, and your moving average is already trending down to show that there is a downtrend, and price is hugging this band here, and then it kept going. But if you missed it, you could have entered here again, then it went down. So, but if you are trading your Bollinger Band on a normal, probably you just want to look for buy and sell opportunities. Always watch out for this 20 period moving average, because it can act as support and resistance. So if you are looking for places of value where you can put your support and resistance, or your take profit and your stop loss rather, say you want to enter a, let me look for a normal one here. So if this is, let's say we are using the 4 hour for example. So perhaps you just bought, you just sold here. You could put your, or you can put your take profit somewhere around here, okay? Or if you sold here, you can put your stop loss away from it at the upper band, since the lower band is normally supposed to send price up, and the upper band is normally supposed to send price down, except for cases where it is trending. But I would recommend that you just use your Bollinger Band for trending market, as it's not always best for trading ranging or choppy market. If you are thought that it would send price up here, it would be very wrong. So there was another sort of compression here, and then there was a break, compression, break, compression, and a break. So finally, let me do it on a 1 hour time frame. Okay, so periods of compression, and price was able to break through. Let me use another pair. So let me use USDJPY for example. So price does not always stay within the band. Price would always find its way outside the band when there is a trend, but there would always be a correction that would send it back into the band. And when it comes back, you know that it is definitely almost likely going back up. So for this, there was a compression at those points, period of low volatility. Someone has their foot on the market, sort of, and then sent price down. So this 20 period moving average stopped it from going, and we already know that market is coming down. So perhaps you missed it, you came to test it again, you could write it down. If you missed it, you came to test it again, you could write it down, and then you came to test it again. So it was finally able to break through our 20 period moving average, and it was able to trade it up. So that is how you use your Bollinger Band. It's actually quite simple, but I don't recommend you use it alone. If you have probably your support and resistance, it can help you to use the Bollinger Band better than you probably are using it. So this is BTC. This is a BTC market to actually show you that it works with almost everything. It works with different markets. So if you check this period, you could see compression around this point, and then boom, it sent price down. So this is a recent one. So as you can see, this is how it looks like in real time. So there was this like a range that was going on here. Nobody was really in control of the market. It was buying, selling, buyer, seller, and then it started hugging price. So it's going up, and this one was going down. Okay, so this is how it will look like. Price would maintain this point. If a correction would occur, it would most likely test this 20 period moving average and throw it back up or send price back up. So if I wanted to put my, let's say I bought at this point and I wanted to put my stop loss, I'll put my stop loss near my 20 period or below the 20 period moving average, because I know once it's crossing it down, it's most likely coming back to meet this guy here. So this one will keep following price either at the distance or closely until another correction would occur. So that is how you use the Bollinger Band trading strategy. But for more information, just get back to me on the group and then we can look at it more than we did in the video.